Good morning and welcome back to Real Estate Economics weekly webinar series addressing value analysis and product identification for land acquisition opportunities. If you recall, today we're presenting a case study for product selection and lot residual, finished lot values for the Moreno Valley, California market area. In our previous section, we looked at the resale market. The resale market's currently collecting about 90% of homes in this particular area, 90% of home sales in this particular area. So that really is commanding the dominant force. It's not presently a robust new home market area, and we can see this in our Real Estate Economics survey-to-survey product. It's another web-based product that anyone can buy, no disc, no book. You can go to our website, pick your market area, and drive all the controlling factors to this to get a real good handle on what's happening in any area that interests you. I've highlighted a couple of areas in green that really need our particular attention today. The first line, number of active developments. In this category, real estate economics would include any development that has not closed out all of its homes, all of the zoned homes in the tract map or in the community. You can see in the past 2 years the active communities in Moreno Valley have fallen from 16 to 10 to just 5. This is a market area that peaked out with 25 active developments in the 2005 and 2006 time period. So we've really shrunk the active community counts by 80%. Let's look at base prices, the next line. You can see a little bit of price degradation, 10 or 15% from 2008 to 2009, but a rebound in 2010. I find that number interesting. We'll have to dig into that and see what's driving that. Look at the average unit sizes. This market held steady in 2008 and 2009 at about 2,700 to just a little under 2,750. Now suddenly we get a jump to 3,341. This is an indication, along with the price data that we just mentioned, that the remaining inventory in this particular market is old legacy homes, executive homes, move-up product, and upscale offerings that are completely out of sync with the current market demands. Those homes lingering on the market as the existing communities continue to sell out, they get a larger and larger percent of what's left and begin to affect the averages. So what we've got in this area is fewer and fewer homes, but they are more and more out of sync with market demands. This can also be seen in the lot sizes. The smaller, more affordable products are disappearing, and what's left is large executive home product. Let's come down to inventory towards the bottom. Total unsold, unreleased inventory, 141 units. Now remember, this is a market that shows more than 2,000 sales on a 4-month basis, 500 sales a month. So if we're looking at the current inventory of 141 units, it's very, very small, and the 1.5 months of unsold, released inventory can't possibly provide the required market coverage. Here's a summary of the currently active developments. If you recall, just on the previous page, we showed 5 active developments, but when we come here, there's only 4. That tells us that there's one community in the market area that's closed or on hold or is not presently open, even though it had been open at some point in time. As I've shown in yellow at the left, 2 of the 4 active communities have released all of their inventory and are really positioned to sell out in the coming quarter or two. The very last, Golden Fields, has no units available. If you recall, we would carry this development in our survey till every unit was closed. Interestingly, the 2 communities that are selling out are the only ones who've really generated significant sales in the most recent quarter. Again, going back to our discussion of legacy and executive home product dominating this market. In green, I show floor plan characteristics towards the right of the screen. Look at the unit sizes that are left in this market. This is a market with moderate to modest household incomes, not that much accumulated equity, usually to bring to the deal. and a job base that tends to be, blue collar in some sense. So these prices and these home sizes that are really oriented towards luxury buyers are completely out of sync with market demands during any normalized cycle. Look at the 5 bedrooms and high bath counts, 4 garages in some cases. This is just not what this market's looking for, but it's a great indicator that there are market opportunities if we can drive a product that resonates with buyers and gets us back into the right price and size points. Here's the distribution of floor plans that are available in this particular market in those 4 developments on the previous slide. As you can see in yellow, the numbers are very, very small. Even the communities that have homes in the 225 to 250,000 range, for example, there aren't any units available. There's only 1 floor plan and no units are available. Look at 275 to 300, 3 floor plans in the existing developments, again, none available. So we have a tremendously undersupplied market under about 300,000. I think we identified in one of the previous slides that the viable price ranges really dig down into the mid 100s, if not lower. So the fact that the new home market starts here at 225 tells us there's a huge price band underneath the current new home market that we should be able to exploit going forward. Again, you can see in green is the list prices. Some of those numbers, 360, 340, that's really at the upper end of what this market can tolerate. And if you look in the blue, the characteristics of these homes, 3,980 square feet for the 350 to 375 price range, that's not consistent with the financial capabilities of this market. 300 to 325 with almost 3,000 square foot homes, very, very large for what we're talking about here. Here's the unit size range distribution. This is just a carry forward from our previous slide. Look at the small units. There are no homes at 1,750 square feet to 1,999 available. None offered in smaller sizes. We should immediately go to those smaller home sizes and formulate a program that will resonate at the lower end of the market here. Look in green, no units to 1,999 square feet, 0 units all the way up to 2,249. We really don't get any available units up until the 3,250 to 3,499 price range, tremendously out of sync with market. Over at the center, I've highlighted the 1 value ratio, $151.82 for one of the available floor plans at 2,250 to 2,499. That's out of sync with what this market wants to have delivered and is really capable of paying for. This particular analysis, another report in a package actually that you can download off our website, shows room counts. This I thought was particularly interesting. The market, out of the 25 floor plans, 12 are 5 bedrooms with 3 or 4 baths. Doesn't make any sense. Look in green, the price ranges here, 409, 345, again for large homes, and the shaded area in blue, 5 and 6 bedroom. 3+ garages, 4 standard garages. Look at this, there are no 3-bedroom, 2.5 baths. That is probably regionally the single most popular floor plan. I would expect to see that followed by 4-bedroom, 2.5 bath, which is also not represented, and then some units in the 3-bedroom, 2-bath, and 4-bedroom, 2-bath. But there's only 3 floor plans there, so we really have a good factual basis for where to go with a product design here. What do we know? Community counts are way down, and most of the communities have released their inventory. Competitive levels are very low, and they're extremely low in the size ranges that match up with this market's capabilities. It's not just the super small homes that are underrepresented, but almost all of the size and price ranges which we might correlate with under 2,500 square feet or under $250,000 don't have any supply here. The best room counts in the region are completely out of production in this market area, and what we've got is legacy product and price ranges. That's section 2 of 3. If you're interested in the whole analysis, please view all 3.